When the market's making new highs, you look inside of it, right? And you can see also amazing opportunities. One of the easy ways to do is look at these charts. Look at this chart. You don't have to be a chartist to see. This thing is breaking out, right? That's a beautiful looking chart. That's your financials. Remember Friday, they beat, and it's doing extraordinarily well. But my next guest says that the really attractive part of this is the upside potential from here. I want to bring in now Flynn Zito Capital Management co-founder Doug Flynn. And Doug, so I guess there's two things, right? We're looking at the chart, and you're not a technician,
right,
but it does underscore the fact that there's momentum there. Wall Street's warming up to it. What are you looking for next as far as a value proposition is concerned?
Well, one of the things, if you look at how technology from the beginning of the year till now went up from 28% in the S&P to about 32, 33, financials held their own. They're still about 13% of the S&P. So while that grew, they did pretty well as well, and at the expense of things like healthcare and other sectors. So the next leg means that in a soft landing, financials do exceptionally well, as does healthcare. And so those are the areas we're looking at, things that maybe don't have such a high PE. Financial PE overall is about 16 to the market's 22. Right. To technology's 30. Right. So from a pricing perspective, if you don't already have enough financials, that's something to definitely look at because the momentum is there.
And it sounds like most people wouldn't have enough financials at this point. But do you buy the indice? Do you buy an index? Do you buy the banks? Or do you just, XLF? How do you go about this? Or do you try to really zero in on the names that you think are going to outperform?
Well, it depends what part of the market we're in and the timing of that. So at all-time highs, I tend to sort of stay away from the higher volatility and higher risk stocks within that particular index. So for a quick example, if you take a look at JP Morgan versus Citigroup, they have pretty similar upside potential from here. Right. But Citigroup has about 1/3 more risk than JP Morgan does. So all things being equal with similar upside, at all-time highs, I would lean into this sort of lower volatility stocks. And if you don't want to get that detailed, certainly the ETF broad-based index is going to get you there. Look at overall, if you already have too much tech and too much of the other things and you don't have enough financials, you're lower than 13%, we would probably overweight that a little bit. That's a good thing to pick up. Also, you're looking at the Russell 1000 value here. Right. So, most people are very growth and very tech oriented, whether they like it or not. The S&P itself has kind of moved that way, even if you're just holding the S&P. And then people added a couple of stocks. Long term, over the past, say 50 years, value has outperformed significantly. It's only more recently that this AI spark has kind of put tech in charge. Yeah, and I think AI is certainly having applications across the financial sector and other areas as well. But value stocks, you want to have both, and there are times when you want to overweight and underweight. And I think if you're looking again and you're severely overweighted and you have a couple of additional tech names, looking to the value stocks, financials fall into that large cap value space. So it lines up there as well, especially if you're very heavy tech, very heavy large cap, you don't have a lot of international. Those are the things that we're looking at is, where are the PEs, how much volatility is there, and then looking in there and saying, what do I already have too much of? Perhaps my next dollar shouldn't go there as well. Let's lean into something that really hasn't moved as much, but also has good potential. That also involves a certain amount of discipline. So, a little bit. A little bit. For the last, I'd say 2 months minimum, maybe a little longer, overall, Wall Street's been talking about, okay, get out of the Mag 7 or lighten up there and start to look at the other 493. There's all kinds of nicknames for them. Sure. The 493, you're looking there as well. What's going to determine the names that you go for? Yeah, I mean, you're starting to see some broadening out of the market overall. The market's overall return the last 12 months has been great, and a lot of that is starting to come from the other areas. The broadening of the rally. The broadening of the rally, not just focusing on the top 10 or the top 7, whichever way you want to do it. But I think when you look in there, the vast majority of those fall into those tech names, and so we all, the outlook is still great for them, and as AI works its way through, but you have to look at things like even in financials, the AI part that's working its way into there, into healthcare. There's applications across all that, and I would seriously look at those areas when you have healthcare stocks trading at a PE of 19 and financials at 16 relative to the market. Those are the areas at all-time highs. Look, if the market takes a dip, and I don't think tech isn't going to perform well, it's just that move up, you want to pick up those higher volatility stocks and the more aggressive stocks after a downturn. Don't be chasing them at the highs. All right, so we're running out of time. I just want to share with the audience, I know you're monitoring the economy, the elections in the seasonal setup, and so because you're somewhat hesitant, you don't have to go
And people watching the show, in your opinion, don't have to be fully vested right now with these big question marks in the air, right?
I agree. I think that with where the bond market is right now and locking in some yields the next year or two without all the volatility of the stock market, especially if you have cash on the side, that's a great place to put some money, have it earned, perhaps get some potential appreciation from the bond prices as rates come down next year, and then look for your opportunity to jump into the stock market after a little bit of adjustment or when you find a stock that's really off and has some potential. I just tend not to chase all-time highs, high volatility stocks. That's a recipe that you're going to have another opportunity to buy it cheaper later on. So have some money on the side, perhaps in bonds or cash to do that.
All right. Great stuff,
Good to see you.
Really appreciate
Thanks.
it. Thanks, Doug. All right.